week we did put out the initiation on Wagners at the end of the blackout period. And we have started with an ad rating and a $4.21 price target. And you'd have to say that the share price has obviously had a really strong appreciation since it listed. Puts into question the valuation and how you look at it and what you think it actually should be recommended. I think it's an ad because we're starting to look forward. So before the IPO, we're doing a lot of focus around the 18 numbers, and that was really just to try and keep some sort of tap on reality and hoping that it wouldn't just completely overheat on listing. So even though the share price appreciation has been strong, I think now that we're starting to close the gap on FY19, and we're certainly using those numbers, you do start to get an appreciation for the fact that there's still a lot of value left in this company. So for me, and obviously my experiences before this has been in resources where everything's cyclical, you really do have very dynamic multiples. It's never just stagnant and what's a fair multiple. For me, it's a simple fact that with a cyclical stock, 1 or 2 years into the next cycle, it's going to look very expensive on a current year multiple because each year you're moving forward. Obviously, there's a lot of system growth coming through, and that's true for Wagners. So if you look at the FY18 PE now, it's on 24 times, but looking forward to 19, which is only a few months away now, that 24 times drops to 19 times, and then 17 times in FY20. So that's on very low ball growth numbers, I think, and it looks quite strong when you look at the whole numbers in terms of the profit growth, but that's off the bottom of the cycle for the company after a few years of construction contraction in Queensland. So very easy for the big wave of infrastructure investment we've been talking about across the East Coast to really benefit Wagners, because it's going to keep the core focus of their big peers on Sydney and Melbourne, which is certainly going to help to back in Wagners and their competitiveness in Queensland, because it just takes some of that competitive pressure off and allows them to go after some of those roads, bridges and rail projects. So the biggest one's the Inland Rail project. I mean, it's going to be over $6 billion of expenditure for just the link between Toowoomba and Brisbane, and really goes right past their base of operations in Toowoomba. So we're very excited for that project to hit its construction phase, because I think it's really going to start to benefit Wagners and deliver some of that earnings growth potential beyond what we've put into our numbers. There's a lot of other projects. I won't go through them all now, but the Cross River project, which is a big Labor government project, that would greatly benefit them. I think they'd win some good work out of that. The Adani Airport, Bruce Highway upgrade, Toowoomba second range crossing still has 12 months of growth or construction in it. So there's a whole list of these projects where they can be really competitive in the aggregates, concrete, cement, across the field, across their suite of products. So then you look at the company and what's happening there, and there's a lot of growth happening there that's not reliant on what the market's doing. And that is that after the end of a 5-year non-compete period with Boral, they're now planning on, and they're doing it right now, re-entering the fixed concrete market, which actually used to be their biggest part of the business before they sold it to Boral in 2011 for a huge multiple. So they're re-entering that now with 3 plants coming online in this half, and they're looking to go up to 8 to 10 plants in total, which would be well over 100,000 tonnes per year of cement, which is the high margin part of the business, with a margin of 24% EBIT margin, so very high margin. So that's certainly going to leverage growth. Now that export terminal has been proposed, and that's Nielsen's one of their customers is involved in it, Wagners won't tiptoe back into fixed concrete. They're going to pretty much aggressively expand back into it. So I think that'll give them the chance to replace all of the potential lost tonnes in FY20 by placing those tonnes themselves into downstream through this fixed network. So very happy with that. All of these positives at the company level, market level, is not considering their new generation products. So things like the composite products, which they're seeing real tangible growth coming through in the electrical crossarms sales, which the replacement rate in the market's starting to accelerate, and all of that's just domestic. So if they start to penetrate overseas, obviously then the quantum of growth from composites would transform again. So it's a highly adaptive business. They completely flex up and down with each cycle. Highly variable, very small fixed overheads, so and very low debt. So that allows them with each cycle to, as earnings or the amount of work that can be won out in the market drops off, they can literally carve off parts of the business and shrink to size to keep to preserve their margins. So that's critical when you're a smaller competitor against larger peers who everyone gets fixated with economies of scale, and it is a great concept, but not when you're a small company, highly indebted. So I much prefer the highly variable way of being able to expand into each cycle, which we're now seeing. Let that transform EPS and keep margins high, which is where Wagners are at. And meanwhile, they can defensively shrink, as I say. So FY19 on the current share price, 3% yield, fully franked, EPS growth of 24%. So lots of growth, fair dividend, upside potential, and the ability to win one of these or to win offshore work. The biggest would be every now and again, a couple of times a decade, they've won these big LNG projects offshore, and where the margins, EBIT margins, are more like 30 to 40%. So it's not to say guaranteed to get one, but they're certainly pursuing some now, which could transform earnings a few years out to another quantum completely. So so I think it's more than justified to be valued at 12 times EBITDA at the moment. I think that there's still a lot of room in there for that to really ratchet up beyond 19. And I think the company is very confident in the numbers they put out in the market. And hopefully, if you look at my 18 numbers, it's a bit about 5% ahead of prospectus, and that's where I'm hoping they achieve after the June half. So more than happy to have it in my portfolio. It's in my super fund. Certainly won't be getting rid of any. And looking for chances like we might have this week if the market has a shock, as Tangy really covered quite well. That'll create opportunity in quality franchises like Wagners, and hoping it gives us a chance to buy some a bit cheaper.